This is Will McCauley with C-Intellect. I'm going to discuss this week's crude oil market highlights. At C-Intellect, we remain bearish crude oil. Specifically, we're looking at the July 2019 contract as we still feel that the market is oversupplied through the end of the year. We've seen a lot of volatility in the oil markets as of late, especially in the front end of the curve. We think this volatility is driven more by short-term news items rather than items that are truly impacting the long-term fundamentals of the market. Due to that volatility, we've been stopped out of our position a few times, but we continue to maintain a bearish viewpoint. One other data point is that weekly we forecast U.S. stock builds or draws in the United States. Last week we projected a build of 1.2 million barrels per week, and the actual build came in at 1.26. So we were very close to the actual build level, and we have a very strong record of reliably predicting that every week. Turning to our shadow trade for the year, we're down 1.9% for the year. Again, we've been stopped out a couple of times as that news-driven volatility has gone against us in the near term. However, we still are sticking with our short-term bearish view for the July 2019 contract. We believe that contract will settle between $44 and $50 a barrel versus the current market trading around $54. So again, as the market reassesses long-term fundamentals, we believe there is downside to the July 2019 and back half of the contract. We're bearish on three main factors. The first is the United States dollar, which continues to be strong. It's up 1% over the last week and 8% over the past 42 weeks. There's a strong inverse relationship between the United States dollar and crude oil prices. As the dollar increases, crude prices decline and vice versa. We've done a very detailed research and analysis piece on this relationship that can be found at our website, cintellect.com. The second factor is the forward curve is currently in contango. It's been in contango for about 14 weeks since the end of October or early November. A contango market is traditionally a bearish price signal for the market. The other thing to note is that the market doesn't very quickly flip back and forth between being contango versus being backward dated. The average duration of a contango or a backward dated market is around 15 months. So we still have a decent period where we believe the market will remain in contango and have bearish price pressure on crude oil. The third and final factor is leased to commercial stocks. We're up strongly last week, up 8.1 million barrels week on week. So for our full research on the crude markets, including bullish and bearish viewpoints, please visit our website, cintellect.com.